All right. Hello, everybody, and welcome to another Pepperstone live event here on YouTube. Today, we're talking about everything to do with volume profiles, an indicator that is not to be missed. We've got a lot to cover, but of course, we'll be looking specifically how it can help us as day traders, and more importantly, how it can help us as scalpers as well. So, Tyrone, from all of us at Pepperstone, we're pretty excited for today's topic, aren't we?
We are. Look, it's a very highly talked about topic, that's for sure, but not a lot of people know how to use it properly or really apply it to their own trading methods. I'm looking forward to getting into it and really probably explaining how to best use it to really probably help your trading and maybe give you some other insights onto how you can actually improve it.
Yeah, this is just a great tool all around. Take profit, stop loss, and even new areas that you could be potentially looking at for entries. So let's grab into the slides here, Ty, and we'll start off with, of course, what we're going to be covering. We'll be looking at understanding what volume analysis techniques can be used. We'll be looking at the three different types that people do usually cover. And then, of course, we'll look at significant volume patterns where we can put some of these tools and how we can get access to them. Just a reminder, the volume analysis tool is available through TradingView with, of course, Pepperstone attached, and it is usually a pro tool. So you may need to look at that when thinking about it. But as you find out today's video, it's well worth it when used correctly. There's also a Q&A as well. So do remember that if you have any questions throughout today's session, please feel free to put them in the chat. We'll answer them. And of course, we're always thinking about what you are really understanding and not understanding, because this is super important. And I think feedback, Ty, and more importantly, people's questions. If you have a question, you can bet 100 other people, if not 1,000 other people that are watching this, probably have a very similar question. So it helps out the entire trading community.
Absolutely.
Okay, so Ty, we always get asked the question, why do we even want to start using volume profiles? Why do we want to use it? When do we want to use it? And all of that. So how do trends actually start and finish is, I think, the biggest question that we need to be covering when we're talking about volume profile introductions. We also need to think about basic yet effective indicators in terms of how we can attach this with other tools. And of course, we want to look at some real examples. So we'll be doing all of that in the first section of today's video. But just before we come back, we'll be just quickly going through a disclaimer. So we'll see you in a few seconds. So, Tyrone, one of the questions and one of the quotes that I always put up here, it's so important, was from Richard Wyckoff. And this has a lot to do with volume profiles and why they're so successful. Of course, Wyckoff told us that successful tape reading is the study of force. It requires our ability to judge which side has the greatest pulling power, and one must have the courage to go with that side. What volume profiles do is they help us understand where the market has actually built a position. So we can actually start to think about, where does Wall Street, where do the large hedge fund traders, where does, in fact, the composite man, which Wyckoff talked about, actually build a position? Well, we can see inside of that. You'll understand that very, very soon. But Tyrone, understanding where price has been entered, and more importantly, the most traded zones in the market, that's such a big thing, isn't it? Can we go through this chart together so everyone better understands what usually happens when a market builds a position?
Yeah, most definitely. And look, when you see the three lines that we've got here, a big trader is going, like when we're talking about institutions, they're not going to come in and put in a $2 billion order. Obviously, they're going to come in, they're going to look for different levels of entering the market because there's simply not enough liquidity to go there. So there's going to be a fair value, there's going to be a cheap price. And as you can see here, when this really replicates what a lot of the live market actually does, it bounces around in between these zones. And what's actually happening here is big positions are being accumulated without you maybe even knowing it. And I think understanding that that's actually happening is very, very important for your trading, because you get caught up in a loop. If you don't understand what's actually happening when a market looks like it's going sideways, you could get caught into a trap of thinking maybe it's going to go short, when in fact what the big players are doing is actually building a position to go long. So understanding the dynamic of how this works is very, very important, because big traders cannot put on a big trade at one price level because there's just simply not enough liquidity. So the price action definitely plays out in this manner.
And often when a market breaks out, Tyrone, it often comes back to that most traded zone. Let's say, for instance, here, potentially 71 cents on the odd US dollar is the most traded zone based on our volume profile analysis we'll look at later. Well, that could be a level that we may want to target for a potential buy after seeing a breakout. It's a great thing. It goes along with what we always say, which is patience, react, don't predict. So Wyckoff also came up with the concept of demand beating supply equals price rising. Demand is less than supply, price drops. And of course, if demand equaled supply, we would have no significant price change and therefore lower volatility, a building of one of these events. So that's something that we always need to understand. A supply or a demand, or really a channeling market or a range bound market, is when there's no significant price change. But that doesn't mean we shouldn't be analyzing it to know where the most traded area is. Wyckoff's third law comes into play, I think, when we're talking about volume profiles specifically. His third law was the law of effort versus result. Basically, Wyckoff said that it is all about the idea that we have instruments changes in price were a result of an effort and generally represented by a trading volume underneath. So if a crypto such as Bitcoin was to consolidate with a very high volume, or a currency, and then after a long bearish trend, so if the trend was going down and then we started to see some consolidation, this could signify that there was a big effort being played. And the move would be sideways with low volatility, but it would suggest that potentially transactions for a reversal could be near. Now, of course, it could break up or it could break down, couldn't it, Ty? And what we're interested more is knowing that when it does break out of this coiling or range bound effect, we understand where the most heavily traded area is. And if it returns back to that level in the future, that could be a trade opportunity for us, whether it's a 5 minute, 1 hour, daily, or any other chart. Isn't that right?
That's right. And understanding that it's not just for entries, it can also be for exits. Because if you're short trading or long trading, regardless of the direction of the market, if you know that that level is going to be retested, or there's a good chance that it's going to be, and you're taking an interim trade against what could be the prevailing trend, that could be a very, very good place to take profit, because you know there's a lot of volume there and a very good chance that it's actually going to go to that place. That's why knowing where those key levels are extraordinarily important, not just for entries, but for potentially exits as well when you're going against the trend and scalping.
If you've watched a lot of our videos here on YouTube, you would know that Wyckoff's theory of the composite man is another one we like. And this comes back to volume profile analysis, which we'll look at soon. Basically, Wyckoff theorized that if we consider all of the market participants, that is Wall Street, hedge funds, everybody else, as being one entity, we could then better understand price action by looking at potential manipulation and how it manifests around. And that's what that whole creation of Wyckoff schematics was. But what actually is a volume profile? Well, a volume profile is effectively a horizontal graph depicting the volume instead of a vertical graph, which is how you're usually traditionally seeing it. If you think about when you usually bring up a chart, it looks something like this in terms of volume down the bottom. And of course, you've got your candlesticks above. The problem with that is that if I gave you a candlestick like this and I gave you a candlestick like this, which one has the greatest volume? That's going to be a great question that often people ask. The answer is we don't know yet in terms of just the candles themselves. This one could actually have the greatest volume in it. But also, we don't know where the price is traded within this. Just because this might have a huge vertical volume, that only tells us one side of the story, doesn't it, Ty? It just tells us that there was a large amount of trade there. But what's the actual price? We need to know that.
It's almost like you're looking at a candle. We know that the candle dimensions give us an open, close, high, and low. That's what actually makes up a candle. But it's almost like a third dimension. Having the profile on that bar actually gives you the dimensions of where that actual price action moved inside that candle. So not only do you have the 4 points that make up a candle or a bar, but you've also got the volumes that go through it. The vertical bars just simply do not show that.
So when it comes to volume profiles, when you put them first on a chart, you're going to be given basically 3 different ranges. You're going to first off get what we call the value area, and that's the price in which 70% of the total volume was traded. It generally depicted by like some kind of highlighted zone on the chart within a certain area. We'll look at that later. Then we get what we call the value area high, and that's the highest price of that 70% total trade volume. And then we get the value area low. And these can both act as dynamic resistance and support, which you will see very soon in an example what we have. The other thing is the point of control. So the point of control is often considered the most important. Why? It's the most traded level or zone that we're seeing horizontally on the chart. And it's just such an important area for us to understand. That is the most traded area. Has it been buyers? Has it been sellers? Well, again, we go back to that idea that if you think about an example, and the example is a range-bound market, and you know that the point of control sits here, and then the market breaks out to the upside, we can assume that the demand is outstripping supply. If the market comes back down to that traded volume, that is the point of control, the most traded volume, we know that they already were most likely building a position there. So it's a great place for us to potentially enter a position. And this is how you start to build a volume profile based strategy. But it also comes down to not changing up the rules. Hey, Ty, we talk a lot about MACD, we talk about RSI, we talk about stochastic. Just like those indicators, it's better just to leave the 70% because it all comes back to normal distribution theory, doesn't it?
It does, yeah. And it's very important that we're not trying to recreate the wheel here or anything crazy like that. We're really adding to our arsenal. And I think identifying what that particular area is and not trying to use it to recreate a whole different method is actually the key there. What you really want to be doing is adding it to your arsenal because it does give you very, very valuable information, but so do all of the other things that we talk about on a weekly basis.
So you've probably been asking the whole time, well, what does a volume profile actually look like on the chart? Well, here's an example. The red line as default is generally the POC. Then you usually get a value area low and a value area high, which is depicted by these blue lines. Sometimes you'll have to add those. So right click on the actual indicator itself or select the indicator inside your TradingView platform and then go and select value area high and value area low so it comes up on the charts. In this example, what we did was we took the high to the low of the previous swing. And what that did was it told us the most traded zone and also the highest and lowest areas that we expected markets to potentially return to. Now, you'll notice there's less trade on the left-hand side down these low points than there was during this middle area. So as the market comes back, notice how it reacts to it. The value area low becomes a resistance as it comes through. The POC gets traded around for a little while, creating some structure in the markets. And the value area high in this case ends up acting with resistance. So it's a confluence zone with another indicator, and it ends up being an incredibly good area to potentially look at doing some take profit targeting. This is just one of the examples that today we'll be using for volume profiles, but it's one of those things that this is what it looks like. In this case, we're using a fixed range volume profile, but there are actually three types that you can use. Which is the best? Well, fixed range is our preferred because you can select the zone that you're interested in. If you see a range-bound market, such as a channeling market, like this, Ty, we might want to put a volume profile over the top, wouldn't we?
Yeah, absolutely, because that really gives us the clues as to where we want to be placing, again, the stop losses and the take profits, but really understanding why the market is there. I think understanding what the market is doing at a particular time is actually the most important thing. Sometimes the market does go sideways and there truly is no volume, and actually understanding that opportunity is just as important as knowing when the volume is actually there, because there are sometimes trades that you don't want to be putting on because there simply is nothing happening.
We also believe that over this next decade, this is going to be basically the decade of people reading volumes more than ever before. If you think about the tape, that's one of the ways that you're used to read it. People used to literally do that in the pits. In this case, volume profiles become one of these much needed tools for every scalper day trader out there. There are also a couple of others that people use. Most commonly used version is the visible range, which basically just has whatever you've currently got on the screen. And you're probably using that version when you first load it up. And that means that when you zoom in and zoom out, it shows you the point of control, value area high, value area low for the visible range on your screen. I don't like that because it doesn't allow us to focus in on important areas and therefore important trade zones. But that might be where you're making a little bit of a mistake with the volume profile. There's also session volumes, which is incredibly useful for day traders and scalpers. So if you're interested in those, I would check them out. So Ty, we get asked the question not only that we like volume profiles, but how would we build a strategy with volume profiles? Can we use other techniques? Well, luckily, we can kind of meld two together quite easily, which is supply and demand theory and, of course, volume profile techniques. So let's take a look today at what we're really understanding when we're building a system of day trading. How do we recognize key levels of market equilibrium? But more importantly, how do we then trade when a market moves from an equilibrium point to another one? What are some examples of supply and demand and volume profiles across a side-by-side, and how could it work together to help you as a day trader and scalper? So Ty, it's all about pair selection when it comes to using volume profiles. We're trading volume. We're recognizing big positional entries. That probably means manipulation is on their cards, and that means we need to trade things that retail traders also trade, correct?
Absolutely. Yeah, absolutely. Choosing the correct instrument as part of your trading plan can't be underestimated as part of your trading strategy, really, because not only understanding it and intimately understanding what it actually does, but also to the point where you know that there is a lot of traders there trading that particular instrument. If you're looking at very low liquidity instruments when you are trading, the volume isn't going to be as important for you, because it's not really, it could be deceiving actually. It could be giving you signals that you think is a big deal. Whereas if you're trading the Euro USD, if you're trading gold, if you're trading the big key indices around the world, you know that they are very, very heavily traded markets. So all of the signals that you're going to get from a volume standpoint are very, very important.
Yeah, so what we want to do is we want to understand trade majors, trade them at the right times as well. USD majors such as the odd US dollar, Euro US dollar, US dollar yen, and pound USD can be used with volume profiles. And this is unique because often, if you think about vertical volume, it hasn't really been traditionally very good with FX, has it, Ty? It's been one of those
No.
ones where we know that it wasn't really synonymous, because what happens is FX is I guess you would say, a little disjointed from the access of how many liquidity feeds you have. And you will get a ton of them with Pepperstone, and therefore you'll have a great picture, but you may not have every single trade in the world. So what volume profiles happen to do is they smooth out this problem. So again, we can start to use them within commodities trades, and of course indices, and of course USD majors plus, can't we?
Absolutely. And look, for a long time, Tom and I have been doing this for a very, very long time. And during currencies, especially in the sort of 2009 to 2015 era, we didn't even have volume on our charts, because it simply didn't make any sense really for what we were trying to achieve. And that's completely changed now. So I think it's actually a tool that has really come into play over the last few years. Technology has obviously brought that in. The TradingView platform has made that very, very accessible for everybody. But now it is actually relative. It's not just relative to stock like it used to be. Now it is relative to everything that you trade, and it's very important.
So why do we use volume profiles and supply and demand theory? Well, of course, accumulation or demands and supplies or distributions, these are areas where the market has stopped. Effectively, it's what we call market equilibrium. Therefore, if the market gets back to these levels, we're interested in knowing the value area low of these areas, the value area high of these areas, and the POC of these areas. So supply and demand and volume profiles mix together very, very well. You'll also notice that in this uptrend, in this example, we have this little stop here. Now, just say, for instance, this is a day trade and this is a daily candle. Basically, what this will be on the smaller timeframes is effectively a distribution or an accumulation, yeah, Ty? And it will be a demand in this case because the market has broken up. This is showing us that in this area here, there's some kind of build of a position. We're interested in knowing whether, again, the value area high, value area low, and POC are of that area. And when the market comes back, if it does in the future, this could be an area where we could look for buys. We already know that buyers won this fight over here, demand outstripped supply. So therefore, when it comes down, we're looking for where that POC is in particular. This is something that I think is unique with supply and demand, and it really comes together amazingly well when using it with volume profiles. So to remember, when it comes to supply and demand, even if you don't understand what it is, and we do encourage you to check out our other videos over here on YouTube if you want to, then you should be looking at, of course, understanding that supply and demand zones only really happen because the big traders are buying or selling. When price falls or price increases, it is basically because of them. Retail traders like us, we just do not move these markets. Now, there are some unique cases where we have in the past, AMC, GME, I guess, in the stocks. But in general, in the FX world, we're talking trillions of dollars of transactions. There's no way we move it, is there, Ty? No. So it's all about knowing that the price needs to be pushed along by big traders. And generally, when a big trader is entering a position, they do so over thousands and thousands of transactions. So they put in small little bits. And I definitely have it, and so does Ty, because we've done some of these transactions before where we've been forced to put in positions at smaller loads, don't we, Ty? So that's what happens when you see these little kind of snippets coming in. Often it's part of a way bigger order, which volume profile will pick up. But at the same time, we weren't able to put in a big one. It's got to do with market integrity, doesn't it?
Absolutely, and most of the time it is an algorithm doing that. It's not an automated bot that's actually picking and choosing a level. What it's doing is actually slowly moving it in. So you haven't got a trader putting in 1,000 trades per day. It's literally done as an automated process, but it's really fulfilling the same purpose, that you've got your fair value that you want, and that order has to be filled. And it is about market integrity, you're right. If we put a big line in the sand at a particular price point, almost like a floor, Tom, which happened with the Swissy a long time ago, nothing can get past that wall, and that's why big orders cannot be put in that way.
Yeah, so it comes back to I was thinking cat and mouse. I can't remember what the analogy is though, Ty. Maybe you remember. But really, the market is also playing that with us. They're trying to say, well, look, we do want to build a large position. We're trying to do it, but we're also trying to do it in a way that we don't quite show you what we're doing unless you have an experienced eye. And that's where, again, the VP or volume profile analysis tools can help us. So in this example, we have supplies up the top here, which were previous points where markets have sold off. And we also have this incredibly strong demand across the bottom down here. But how could we possibly figure this out before it even happens? Well, do remember in supply and demand theory, there is an option which is basically a drop and what we call a base, which is in this case a supply zone because it breaks out, and then a retracement back to this level. I think if you're starting to kind of get an idea, if we used a fixed range volume profile from this high down to this low high, what it will often do is it will give us a POC through this range. And basically, we will most likely then see an area which is effectively the market equilibrium. If the market comes back to this level, it could be a point where we want to short off it because the market liked it before. They pushed the market down. The trend is still down at this stage. So it makes sense that could be an area that's heavily contested by a bank or institution. Here's an example of how that might look on charts. And we've used here a recent example of gold, which basically what it is, we've taken the high to the low, and we've found that this was the most traded zone. It's not even close. I mean, this is a heavily traded zone. You can see an initial reaction to that point. Then we have a full supply through here, and we have the value area high, which is dictated by this blue line and this arrow. So what I like to do, Ty, is I actually like to box within this area. If you take a look here, this is now the box zone where I would be looking for shorts if I was trading gold recently. And this would be where I'd expect shorts to happen. And then I'd expect them to probably come back down into this zone at least. Maybe not go as low as they have right now. But now that they're here, guess what? We can use volume profiles to potentially work out where the market's going next. So what a useful tool it is, isn't it, Ty, to see where the biggest trades have been?
Absolutely. And look, not only that, I mean, it really encompasses all we talk about with technical analysis as well. There's all sorts of reasons why, that is a really important level. It's a psychological level. It's the 1980 level on gold. This is a very recent price chart. So, for those of you who follow gold, you'd know this. It's also pretty close to a 38.2 fib retracement as well. When you apply the volume on that, what the volume profile is doing is it's greatly enhancing all the other tools that you're actually using. Like if that's a 38.2 fib, which I'm pretty sure it's very close to, you're going to find that the point of control is actually right on that 38.2. So how strong is that level, Tom? Like it just means it's so much to know that it's not just a Fibonacci telling you that that's a key level, not just a price point is telling you. You've also got the volume to actually back it up. And if you're looking for more evidence there, it doesn't come any greater than that. That was a really, really great example because I think it encompasses all of what we talk about in TA and how you can add it to your arsenal to make all the other tools that you already use so much better.
Yeah, and I mean, I was just kind of highlighting this area here. That is an exceptionally good little trade zone in there if you know about first time frame changes of trend as well. It's an exceptional little area. So we could apply the same theory and say, well, if we get a break to the low down here, where's the market going to next? Can we use volume profile in that action? Well, by using fixed range, we certainly can. And of course, we can pretty much make some predictions, although we don't like to make a prediction, that there could be a trade lower in the future. And if it does go lower, that there is very little trade volume through this range here on the left-hand side. In fact, it is more likely than not to come back down to this red box. And this is what we call a market moving from an equilibrium level to the next equilibrium level. And it becomes incredibly important for us to understand this on charts and, of course, break it down. So, Ty, volume profiles are clearly massive. Fixed range is the one that we've been talking about in this section here. And, of course, we want to pull from previous swings to understand what price might come back to. If we understand what traders have done in the past, especially big ones, then we can guess where they've built a position and see it on front of the charts. It's like seeing the footprints that we often couldn't get back in the day. And it helps us make better trades, doesn't it?
It does. And look, time and time again, yes, we're using an example on gold, but if you go back, even looking on the recent charts, you're going to see this happen time and time again. It's not just a phenomenon that's just happening now. It's been happening for a long time. It's just now we've got the tools to actually analyze it.
Okay, so the last section we want to talk about here today, Ty, and in fact, a section that I think all of us like so much is session volume profiles. The question is, are session volume profiles any good? Should we be using them? Do they help us as day traders and scalpers? And more importantly, what are we actually trying to recognize with these session volume profiles? Most of you probably don't even know what they are when you're first watching this video. And the reason is quite simply because less people use them, but they could be a good tool for you. So why could they help us? Well, of course, there are 3 sessions during the day. In this case, the session volume profile makes up the entirety of that day trading. But what it can do is it can show us the previous session, the most traded zone, and more importantly, where volume was moving to and where it wasn't. So Ty, when we're trading and we start to take on trading as a career or as a path that we want to get serious about, we've got to make a hard decision. Which session will we trade anyway? Asian session, London session, or US session? This means that we might have to pick different instruments, doesn't it?
Absolutely. And look, the instruments are very, very relative to the time that you are trading. So, you're going to always, you're not going to, Asian stocks or Asian indices aren't going to move as much in the London sessions. Obviously, that crossover period in particular where London and New York are open at the same time is a very, very highly traded volatile area because there are 2 major markets trading at the same time. That overlap that we've got marked over here. And sometimes that actually does cause quite volatile markets because just because big institutions are trading, it doesn't mean that they're always in agreement with what's actually happening. They've got their own path to set. So that does actually, provide some very interesting periods throughout that overlap zone. But then things do steady out throughout the US session. One of our favorite sessions, what was for a long time, was the US session. But it really depends on what time.
I think that was more your one. I couldn't stay up or
get
up
early enough for it. I do love it. But really, it's really understanding which one that you're going to be most comfortable in, and also identifying the instruments that are going to track best in that particular period, because you really want to enhance all of your opportunities and you want to be trading the right instrument in the right session, most definitely.
Yeah. So if you like to get, I guess, into the fast lane when it comes to day trading and scalping, often London session, the overlap are the 2 big ones you'd want to use. So the question comes back to, well, which kind of volume profiles would we use if we want to trade sessions? Well, of course, I think session volume would be pretty useful and it's quite good. Fixed range is also very good. And I do think the visible range suffers in this case. So remember, if you're starting to use volume profile and using visible range, I'd probably say maybe start to play with the others and see whether they work for you. So Ty, we all know price action trend. I'm sure everybody here is at least intermediate to advanced. And you all understand the series of troughs and higher peaks and higher troughs and higher peaks and higher troughs mean an upward trend. And of course, the opposite for the other way in terms of short positions. But of course, we know that markets come back to certain areas. And it's what we call swing trading, or at least the 2 steps forward, kind of 1 step back kind of analogy. Now, markets don't always have to do this, but a pure technical market will tend to do this after a breakout. So when we're talking about finding opportunity using session volumes, what we could do is we could load them on a chart, and you'll notice it gives us what we call the point of control for each previous day. And this kind of is benefited by this big red line here. Now, of course, we can add in value area lows and value area highs. But what it can do is it can show us areas that the market might want to retrace back to. Let's say in this previous session, the market breaks out heavily and then it starts to sell off. If this next session picks back up to that 1.102, if that then had another trigger of confluence with it, it could be a good point for us to sell, wouldn't it, Ty? Because the market sold off from that point. That was the most traded level. As it comes back, that's probably going to be a Fibonacci. There could be a moving average on it. There could be quite a few other reasons. And it can help us from that as a trading perspective. It also helps us to understand when big market moves happen, that they might be through as this candle's gone massive. So therefore, it could be a gap that could come down and fill later on. But notice how the market comes back and tests these areas in the future. I love the session volumes for just being able to recognize the most traded zone.
Very important. And also, when you see these opportunities, remember what our mantra, we always talk about: the patience, react, don't predict. These are all there. Not every single one of these levels is going to be hit every single time. It's all about actually being patient enough to wait for the correct opportunities, because the trading game is really about trying to find the best opportunity with the least amount of risk. So you don't want to be taking every single trade that you see. You want to be waiting and having the patience for the right setups to actually happen, to come back to the right zone. And as you can see on this chart, most of the time they actually do, but not all the time. So you don't want to be creating trades out of nowhere. You want to be making sure that the market's actually at the right level to take advantage of, to put the odds in your favor, because these tools are all about trying to give you the edge on other traders that simply don't have them.
Yeah, so here's an example of a market that obviously is reacting to news. News spikes the market down heavily, and you might think, well, it could continue on. Absolutely, it could. But in the scenario, it might also want to come back, because what we notice is there's very little trade volume through a lot of this candle, because we can see that from the previous session. It shows us it's a little bit thin. What that means is that if the market retraces back to this point of control, that could mean that the market is fairly distributed, basically price, and therefore it could be a good area for us to place a sell, or at least consider that from a day trade perspective. You'll notice the market spikes right into that area and then sells off. And it's not the only place that we can use it. Here's an example of the US 500 recently. In fact, it's taken pretty much as of today's recording. And what we can see here is that the market has effectively filled a trade gap. Notice over here, not only do we have a gap, which is the difference between the previous close and the next open, which means that basically markets have traded in the volume futures, but look at how little trade went through here. Basically nothing. And therefore, it's not proper efficiency of markets. And markets love to fill these eventually, don't they, Ty? And it's a good opportunity to be able to see that visually on a chart.
It's almost a foregone conclusion when that happens, isn't it? That it's actually going to be at the right place at the right time. And really, when you understand them and actually isolate them as a trade, it really makes the decision-making process a lot easier at the right levels, doesn't it? It certainly gives you a big advantage.
Yeah, it gives us a very visual, and we are visual creatures. I think once I learned that you could memorize everything by thinking about a storyline and then putting pictures on it. And in fact, I think it's like, I don't know, it's a ridiculous stat, Tie, in terms of being able to memorize to like a card or to some kind of picture or association. That's the way that actually we best recognize and have great memory with things. So being visual creatures, this is a great way of visualizing something that's sometimes hard to explain or understand otherwise. So session volume profiles, they're pretty good, and they can be used in your day trading and scalping. These are some of the ways that you could use them. So of course, we could use them to find gaps. We could also use them to find areas where we've seen large trades happen before. Therefore, if market retraces back to them, it may happen again. You want to attach these to your other systems and then use it as a confluence technique. And we believe that that's where volume profiles can give you the biggest edge. So of course, if you've enjoyed this content so far, please remember to give us a big like in terms of down below in the YouTube comments and everything. It does help Pepperstone know that you like this type of stuff. But I'd like to hand it over to questions, Ty. And as well as that, I'd like to jump in front of the charts. So let's actually get in the charts right now. And we've got here some session volumes on the US 500. But what we might do is we might do a little bit of work on fixed range. So what do you think about that? We've got some questions here from some people. And Evans says here, what is the volume called in TradingView? So it's called volume profile in TradingView. What you would do is you would load it up like this. You would type in volume, and then you would type in profile, and you'll see that you'll get session, fixed range, and visible. Now, admittedly, this is a pro tool, so you may need to sometimes buy, I believe, the pro edition, but you can hopefully see how it could be helpful to you. Now, if you wanted to select fixed range, then you would select fixed range, and that would, of course, give you the indicator. And if we pulled it from this high to this low here, what you would be given is, as I said, the value area high, value area low, and the POC. So we can go into this and check settings. We can go to style. We can click value area high and low. So you can select your colors here. Very important to make sure you do that. And then I like to have it something like this. You can change your color. People have all sorts of different things. What you'll notice is that the market likes trading this zone right now. As it comes back up, just like it did a few days ago, it tested this area. That was a heavily traded zone by Wall Street. All the way through here was very well defended, and it sold off. Right now, we've got a bit of a thin level. So as you can see, it is possible for the markets to bounce here, but we do know that this is basically the wall area on this current chart. Ty, what do you think? I think there's a few questions for you as well coming through here in the room.
Yeah, look, I think the S&P 500, especially over the last few sessions, has been trading 101 really from a technical standpoint. I mean, the technicals have stood up for a very long time, and having these tools, I think actually even at the end of a potential big market move. Like we've had a very, very big market move in the S&P 500, obviously, and we've isolated a couple of areas now as to why it might weaken. And having these tools available to you on the way down or when the market is starting to weaken is actually invaluable, because a lot of these key levels that were there previously, stopping it from going up in the first place, are actually now there and giving you the levels that it's actually going for on the short side. So it really is a self-replicating device, in the sense that when you've got perfect trading going up from a technical standpoint, the way down is often very, very technical, in especially when you put these tools in place, because you know where those key levels are, and quite often they're going to coincide with a very key level. Like you got that circle there, it's somewhere around the 43.30 level. Now we know if you go to a chart, the 43.30 level on the S&P 500 is going to be a very, very strong level, and there it is. Yeah, the volume actually does that for you. It tells you exactly where that level is. But yeah, it's the thing is, though, like we mentioned earlier, what you don't want to be doing is completely relying on the volume profile. You still have to overlay it with technicals. You need price action to be playing the game. But when the volume profile confirms what you're seeing, it adds a very, very important dimension to the technicals that you're actually seeing. So that's why it's so important.
Yeah, and I think just in this example, of course, if I keep pulling this across, you'll see how it turns. So basically at the moment, from the low to the high, this is the most traded zone. You can see it's not even close based on the histogram. But as we pull across, if I pull there, it's going to come down the bottom, I would say. And that becomes, as you can see here, my most traded level. This level is hugely traded, and it marks kind of a very important point, as Tyrone mentioned, around that 43.50, 43.30 kind of area down in this area low here. If this market is to break, the next level of equilibrium could actually be around 41.51. And there may not be that much. There's little bits of demand that could stop it here and here. But in general, there's a relatively good chance that the markets could move lower and actually make it back down to the 41.50s. So it kind of breaks down what you're looking at here in front of the chart, and understanding again where the biggest positions are. The longer the structure, generally, the bigger the volume. But that's not a given, because, of course, it could just be really light through structural creation. And then as it breaks out, there could be just monstrous amounts of trade. Little hint, Ty, when it comes to thinking about candles. Again, we use doji here, long leg doji, and kind of like the big one like here. We don't know necessarily, just based on the candle, which one actually has the most amount of volume. But what we do know is that because it's a doji, the market is kind of finding equilibrium in this point. That is, that the trade has gone up, the trade has gone down. It ends up being smack bang pretty much on the same level. So that means that probably the most traded zone through a long leg doji is the middle itself, isn't it? And it's just that way of understanding the markets.
That's right, exactly. And when you see big outlier moves at the high and the low of the doji is, that they are quite often the ones where the volume is going to be the smallest, because realistically, that's what moves the market. You saw in the earlier example, when you see a big sell-off, those big red candles that were dropping the market, the volume was at its lowest when that was actually happening. And it's not much different to the doji candle, in the sense that when these extreme levels on that candle are being reached, you'll find that volume is not really focused in that move up or that move down. That the real volume is actually happening in the middle, where the war is actually taking place.
Yeah, that's right. And it's the middle is the war. And often, if you actually break these candles down, if you think of it fractally, it'll look like this as well.
Yeah,
exactly. So it'll actually be a range.
Yeah.
So it'll be like that kind of thing. Now, Ty, we've got a question coming in here from Reese, and he says, when can we get Westy on a live? That's a good question, isn't it?
That's a really good question. But Westy doesn't like staying up past 8 p.m. on a Eastern Standard Time. I can tell you that. So he's not going to be on our lives.
Is that true? And he also has good things
to
say
about very early. Westy gets up very early.
Yeah, that is true. That is true. He's probably trading the back end of the New York session time like we used to do. He's doing that 4 a.m. That 4 a.m. stint. Reese says here, Pepperstone is the best broker out there, clean, swift, and easy to use. Well, we appreciate that, Reese. Thank you very much. And CME says, fantastic, Pepperstone. Great to see you as well, Charles. I believe that's you. And Sir says, nice first time live. Well, if you do have questions, feel free to ask them, guys, as we go through this. We're happy to, we're here, we're live right now, so you can feel free to ask them. And for people watching and recording as well, make sure you attend these sessions. And if you do, smash those like buttons. It does help out, because you can ask any questions. You can say, well, can you do this on this particular chart? At least we can analyze it together. And that's the beauty of doing these things live here on YouTube. We've got a bit of education. We've obviously got a bit of practical application as well.
Yeah.
Tom says, what happened to my hair? I don't
That's
know,
a
man. I
funny
got slicked
question,
over.
Tom, that you say that. The first thing I saw when I joined this live stream
Yeah,
this morning
he
was,
did say
yeah,
that.
Tom's hair. I was actually very, very impressed with the
Mm.
style that he's got. I do believe what
Oh,
he's
really?
doing.
The
Yeah,
slicked
I
back.
think he's doing. He's actually practicing a few different hairdos to see which is the most popular for when he presents at our Vegas conference later in September. I think he's practicing
Yes.
on which one's going to be the most popular. So you might see a couple of different hairdos in the coming weeks to maybe even have a vote. Tell him which one you think will be the most appropriate.
Which is the best style. All right, let's do some analysis here using a volume profile. We might as well jump into another chart, Ty. We'll jump on over to everybody's favorite, I guess, which is probably the Euro USD or the odd USD or something like that. So we'll jump into that on the Pepperstone platform, and we'll just kind of do a little bit of analysis here so we can see how we could break down this chart. Now, if we're doing a day trade, we want to start usually on a higher time frame anyway. We want to make it, oops, we don't want to necessarily remove that, but we do fxevolution.com. But over here, we've got, a creation tie. So what we could do is we could actually take this low to high. We could understand where the most traded zone is. Now, where do we find ourselves right now? Well, miraculously, we're back right in that area, which of course was reacted to once before. So that's, I think, an important acknowledgement of where we are. Now, if markets do break further low, there's a good chance that they could go down to this level as well. And what we could do here is we can kind of understand, all right, well, that's interesting and all, but what if we added a second fixed range volume profile from the top down to the low? What was the most traded zone? So we know it's this area here. And what that does is it helps us kind of say, well, if markets do rally here, there could be a short opportunity on the smaller time frames around that zone. We could highlight that. We could create a little box, and then we could just set an alert for it should it happen. And it doesn't seem to be even close. Look at that. Look at that trade that goes through that area. So it's a very significant area. Then what we could do is we get a fixed rate, something like a Fibonacci, and we could overlay that as well on top. And we could say, okay, well, is this also a drop and a base and a drop, similar to what we talked about today? Again, we're putting together the pieces of the puzzle. Do I like that zone? Yeah. Do I know it's going there? No, I don't know that it's going there at all. Tyron and I don't have the predictive powers that some people would think in terms of being able to always predict things. But when you have edge, you have edge. And that's the difference between professional trading, somebody that's doing really well, and someone that isn't Ty. It's not my ability or your ability to predict. It's our ability to understand when we have edge in the markets.
Exactly right. Yeah, we couldn't tell you exactly what the market was going to do, because if we could, no one can, because no one really knows. I don't even think the big playmakers know. But what they do know is where they want to buy and where they want to sell, and this is what we're trying to identify: understanding these levels and knowing where we can get involved. Remember, a lot of people fall into the trap of thinking that the market's always working against them, and really, or the brokers are working against them, whatever. Like, it's an easy thing to think when your stop losses are being taken out, but most of the time you don't really know what's going on. These tools are giving you the understanding to understand what the market is actually really doing, because you need to work with the market, not against it. And when you understand the market dynamics, understand the levels that we're talking about, or what's happening in the market, it gives you an extraordinary edge, because it really means that although you're not trading with the same volume as the big players, you're actually trading in the same direction, and you're also trading at the same levels that they would be potentially entering or absorbing volume. So it's really, really important to join the, you don't need an edge. A lot of people also, Tom, think they need an edge that nobody else knows about, because that's their edge. It's actually, that couldn't be further from the truth. Trading like the big traders do, and in the same areas that they do in the same direction, is your biggest edge.
Yeah, well, that's right. And it helps us to break down quite a lot. All right, let's do some rapid fire answering here. So we've got Reese saying, if you look at the US 30, which is the Dow, for anyone that doesn't know, POC normally works well with the levels it gives. There you go. So it's something maybe you can check out and test. Then we've got another one here, and says, what do you think about open interest with volume? So when you're saying open interest, I assume you're talking about options. Is that correct, Elena? Please reply if you can before the end of the session. Radish says here, good one, guys. I've used it before, but you brought great clarity on when it is useful. Yeah, it's not always useful. Sometimes it's better than others. If you do want more clarity on it, I'm going to do a shameless plug. Yes, we do have a course on it, of course, which is called our Day Trading Masterclass, and it's over on fxevolution.com. But you know what? It goes through this and a lot more detail, and we also back it up with every week we do a Q&A, which answers questions as well. So if you're interested in finding out more about VPs, supply, demand, bringing it all together into a replicatable system, that's something we do. Then we've got a question about XAU. which is, of course, in this case, I'm guessing you're talking about gold. So, yeah, I mean, I'm assuming it's gold versus USD. But if you're doing analysis here, I don't really have to do too much more. But you can see that there is a heavy trade level that sits around 1957. We're trading quite a lot under that. In fact, the example we used before was that if markets actually breach under here, there's a high chance that markets will move here because this was not a fair distribution. So therefore, there's actually very little volume trade in this area. And this could be a movement from equilibrium to equilibrium. Of course, it's not a sure thing, but this would be a critical level that I would set alerts for. I think Tyrone would agree there. From here to here doesn't make much sense to stop, does it, Ty?
It doesn't. And you know what? It's funny that a lot of people actually are of the belief, and until you can actually use a volume profile to know it's actually not the case, that when a market moves very, very quickly, like with those big candles that we can see in that previous move, that there must be a lot of volume to actually make that happen. But that's actually not the case at all. And quite often, the really, really big moves are actually done on very, very small volume. And that's why the market can travel from equilibrium to equilibrium very, very quickly. And understanding, what you wouldn't want to be doing. As an example, right? That range that we've identified, the next equilibrium zone is that big red rectangle down the bottom at around that sort of 1840 level. If you are looking at a short opportunity and you get a good quality entry at around the level where it breaks through, there's no need to have a take profit, 20% of that distance in, because generally speaking, it's a pretty good chance it's actually going to reach the long end. Like a really good chance of actually getting down there. So it really helps if you take profit placement. And I think it's one of its biggest advantages actually, because it really identifies the levels where, I know traditional support and resistance does that as well, but this adds an element of really, really important market dynamics, because for a fact that there's actually very, very strong volume. The problem with support and resistance sometimes is there's a market build-up there, but that could also be done, like I mentioned earlier, on very low volume. And it may not have the same significance as a very high volume traded area.
All right, some other questions here, Ty, that we've got coming through. I guess my analysis for gold would be here would be where you got here. In here could be a zone of shorters. And at the moment, we are on demand basically within volume. So you can see here the demand is around this area. If it breaks underneath, I would expect markets to be fairly volatile here. Janet says 2 hours seems to be a good combo for analysis. Yeah, I like the 2 hour. It's pretty good, especially if you're using session volume as well. But 2 hour daily, all good to start off with, and then go down to your 15-minute, 5-minute charts. You will see us sit on this a lot, and then we only break it down once we find the level from the top down. You'll find most traders do that as they go through the years. But doesn't mean you can't trade 1 minute, 5-minute charts. You just need to be aware of your surroundings. Yeah. Remember, context is everything when it comes to knowing these levels. Avery has a question I might have to get back to. He says something about the bell curve, and basically he's saying, what about the bimodal distribution? I assume he means, like, Ty, that it's like this here, but actually there's other volume that's over here, yet the trade is within this range. I think it really is impacted a lot by the heaviest trade zones. So sometimes you will have, these large volumes over here. I'm not sure if it's really too important to our analysis techniques. Really, we're just interested. You can see on the chart the most traded levels based on the histogram. So really, with value area high and low, I wouldn't worry too much. POC and the most traded zones based on the histo would be what I'd focus on.
I think you don't want to
maybe we'll get back
paralysis.
Yeah, probably doesn't matter too much.
Yeah.
The other question we've got here, if you're only trying to trade big volume days, which indicator would you use? Big volume days. So you're only going to trade extreme volume or extreme moves in general. An indicator is going to be hard to use in particular because most of the time it's going to break out and all the indicators are lagged.
They're lagging. The problem is, they lag. So they're not really going to give you any information that's actually useful.
You'd have to use a price action based close system.
Yep.
Yeah. Really. You just have to say big volume's coming. I look for a close. Once I see a trigger or a specific kind of replicatable technique, so one that I would think of straight away is something like that happens, a big one closes above it. To me, it's on.
Price action and candle action is the only real leading indicator that you can use in those environments, because by the time traditional indicators catch up, you've always got to remember they're always lagging. They're always using previous information. So they're not going to be anywhere near as relevant in big volume, especially big volume days and big range days.
Yeah. That is correct. Then Avery says, what's the underlying logic behind volume profiles? That mean reversion is often inevitable. Well, that markets trade a zone and they take a while to replicate, enough entry. So what you are assuming is that they've just because markets pressure down or above or they start moving, that particular trader got everything they wanted. Oftentimes they won't. They might only fill, they got fill problems. When you start getting into the billions of dollars, you just cannot get enough of that particular stock or that particular currency or that particular thing at the price. So basically the underlying logic is that is a defended zone. So as Tyrone mentioned before, the classic defended zone was when a central bank comes in and defends an area. That's literally basically creating a wall, and that wall will become the highest volume trade because they're defending it. So think of that like what this is. It's basically a wall which is impenetrable because it is not in best interest of that institution that's placed a lot of positions here to let that break because they know it will then move to the next level of equilibrium. So it's kind of like a self-fulfilling prophecy in some ways as well.
And Charles, the lag it can be quite significant. Look, for the most part, most indicators are using a 14-day as a traditional default indicator. Most of them are using the past, or it's 14 periods, not 14 days. So using 14 periods, so whatever time frame that you're on, if you're looking at a daily chart, for instance, those indicators are going to be using the last 14 days to base their current movement. So you could imagine that the last or the only current day is going to be the most relevant. But it's not going to give you an equal curve. So that's the problem, that they fall behind very, very quickly. And that's why you see markets accelerate very, very fast away from moving averages in particular. The bigger the moving average, of course, the more exaggerated the move is going to look when you get a very, very big range day. It's going to accelerate very quickly because the moving average simply cannot keep up because it has to factor in the previous 19 days, for instance, on a 20-day moving average, even if one day completely breaks out and blows apart all of the ranges. So they're very laggy. As a rule, indicators can be very, very laggy.
I don't know if we'll have time to do odd USD, Abdul, but I will just quickly answer partially this question for Alina. So the open interest question, Ty, was to do with overall, I think, the crypto market. Now, in the crypto market, you, of course, can see the level 1, the level 2 data, which I assume is what you're talking about in terms of the open interest. So it's not the open interest of an option, it's just the open interest of volume itself. Look, you can see it and it will interact with it. There are certain ways of getting edge, but it's not an easy answer to answer straight away. It would probably take around an hour. And the reason is you need to understand how you would use the volume profile, how you would then stack that with some kind of technical analysis, break or zone, and then also how it reacts to one of those levels. So say there was a ton of open interest, the market came down, stole that liquidity, that turned out to be a POC as well on a higher time frame, and then it suddenly shot off in the opposite direction. That's probably symptomatic of a liquidity steal. So therefore, it could be an incredibly powerful method. And I do cover some of this in, of course, our day trading masterclass. So I guess that would be, the way I would look at it. But it's a great question, and you're starting to think outside the box. So that is an important aspect. Now, if we go and consider over here the odd, I'll just quickly draw up here again just to keep it consistent, Ty. We know the most traded zone through here seems to be up there from this point. We would also want to know, because this is all basically range bound on the 2 hour, the most traded through this entire range bound area, which is here, which we already have. So at this stage, the market is trading underneath. I'm not going to break down the small time frames, but you know that this is going to be a critical point in the future. And therefore, if it tests from the bottom up, you've got to expect resistance. So that would be one analysis technique I'd use. Then I'd go back, do all of this. It may take me around 5 to 10 minutes to fully analyze the odd the way I'd like to. So yeah, we don't have time for it today, but that just gives you an idea of how we'd start doing this. All right, guys. Well, from everyone here at Pepperstone, we hope you enjoyed today's session. If you did, give it a heart, give it a thumbs up, all of those types of things. It does help bring more of this content. Remember, we do it every single Wednesday, which is at 8 p.m. Australian Eastern Standard Time, unless we're incredibly sick or something. So in general, we're always covering these things. And of course, we do hope that you are having a great week, and we hope that you join us for next Wednesday's session, don't we, Ty? And of course, we'll be bringing you some excellent content.
Absolutely. Thank you so much for your time, everyone, and we look forward to seeing you all next week.
All right. Bye, everybody. See you for now.